Well, when you discuss risk or about evaluating projects, Roger, it sounds as if that you're talking about quantitative measurements. To what extent do qualitative considerations come into play?
You're talking about a combination of quantitative and qualitative. One of the issues on quantitative is what is the sensitivity of profitability going forward if sales volume goes up and down. Too many people sit down and do a single projection. They need to understand the ups and downs of the business that they're looking at. What is the impact of sales volume going up, of pricing going up, pricing going down, costs going up, costs going down? A scenario analysis. You look at various scenarios, you look and you plot them out. It gives you a sense of the profile of cash flow that you may in fact be getting into with the acquisition, as opposed to a single best guess or single most optimistic projection with using tools that today are available easily to the analyst, the financial executive. Any of the spreadsheet models properly laid out can help anyone determine what risk is. It's the spread that is important of the potential middle ground cash flow, the expected cash flow. The spread is just as important because that's the risk. That is, you'd like something where every day you're going to collect exactly what you thought you were going to. You're going to sell what you thought you were, and it's going to cost you exactly what you thought you were. The risk is on the downside. I like to think about it as downside risk. No one thinks of making more money as being risky. It is the possibility of what could happen if sales volume goes down, pricing goes down. Pricing doesn't increase as fast as costs. The downside risk is the scenario that you should be focusing on when someone is doing an analysis of a potential project risk.
No, there's no question about it. The idea of putting all projects on an equal footing is quite appealing. But remind me, Roger, how does discounted cash flow, or DCF, do that?
Well, the DCF is a very flexible framework for analysis. I think some people think it boxes you in a certain way. It can be very flexible. And that is, each set of the underlying assumptions. If you think about analyzing a business, it's revenue minus cost of goods sold, minus operating expenses, right down the line. Each one of those can be tested for through the use of spreadsheet programs today in the format of the discounted cash flow to understand how they move. The wider the variance, or the more downside risk one project has compared to another project, the riskier it is, the higher the discount rate that should be assigned to that project.
Let's make sure I understand you, Roger. Are you suggesting that there will be, or there should be, a different discount rate for each project a company undertakes?
Well, yes. You're supposed to match the investment discount rate, and that's each project a company has its own risk profile. You should be looking at what is the appropriate discount rate for the risk of not realizing the expected cash flows. Now, a lot of companies default to sort of their overall weighted average cost of capital. It's simple. It is a mistake, because what they do is low-risk projects, they're discounting at too high a rate of return, not accepting them. High-risk projects, they're discounting at a lower rate of return, saying they're more valuable than they really are relative to the risk of those projects. So cash flow projections using the discounted cash flow is a tool, and it is only one part of the evaluation process. It is the way someone can help themselves quantify the risk of a project, and then basically look at, on a relative basis, compared to the existing business. Companies need to look at what's the downside of their existing business, and then look at the profile of the potential risk of a new project. Is it higher risk or lower risk?
Let me pose a very real scenario. The scientists in the company are urging more money be spent on basic research that will pay off in 10 years. The operations people want to modernize existing plants, which will pay off in 5 years. Meanwhile, the marketing staff wants more money for the sales staff, which will increase next year's revenues. How do you weigh these alternatives, Roger?
Well, first, you want to look at what the potential payoff is and the downside. You want to understand in each scenario not only the potential timing of when you'll receive the cash flows, but the chance of receiving less than what you expect. Then you're going to rank each one by its potential risk, and you're going to assign a higher discount rate to the more risky and a lower discount rate to the least risky. You're going to present value the expected cash flows from each one of those based on the discount rate. And the discount rate helps you equate the relative risk and the relative timing of the project. In your example, Becky, you talked about the payoff in 10 years. That could be a big payoff, but it's way out there, so in present value terms, it's going to take a lot of return to make up for the wait in time. There's also potentially a big risk. Many companies are looking for projects that they can, R&D projects that they can sort of increment in the sense that they're able to judge all through the process whether or not they stop. Because we talk about one of the things that in business decision making is not just I make a commitment now for a project that's going to potentially pay off in 10 years. I need to know and be judicious about pulling the plug in the meantime and cutting my losses in between.